By the end of this video, I want you to better understand the basics of credit, how to build credit from scratch, and then learn for some additional steps to use credit as part of your wealth building strategy. Life can be way more difficult without good credit history. Trust me. If you want to buy a car, a house, or even sign up for your favorite cell phone plan, let's say, you're going to need good credit. But first, what is credit? Credit is defined as any relationship between a borrower and a lender in which the lender gives money to the borrower with the agreement that the borrower will actually pay that back as a sum of money to the lender at a later date. But really, credit for most of us just refers to the credit worthiness or credit history of someone. So when we're talking to someone, we're like, what's your credit like? We're really talking about your credit score, right? Your credit score is a scorecard that defines how responsible you've been with the money that was lent to you. It acts as a barometer for the lending institution, the bank giving you the money to borrow, as to how risky or how good of a borrower you might be. This applies to things like buying a car, buying a home, leasing a car, or even the apartments you want to rent. You need good credit to even have access to these things. And these events are also reported on your credit history. If you want to rent a new apartment or even get your own cell phone plan, they'll need to run your credit history at some point. All right, why does credit even matter? Credit matters because it can determine your access to financial tools that help in building your wealth. You may not think about credit in this way, but just go ask any millionaire or someone who's really successful, and I bet there's a good chance that they use credit in some way to get there. Credit gives you access to credit cards, loans, lower insurance premiums. And the better the credit score, the more favorable terms that you'll likely get for these tools. Now, if you have a bad or even no credit history, some companies like utilities and cell phone carriers will even make you pay a large deposit up front to cover multiple months worth of your bill. If you have a great credit history, you'll pay no deposit for things like this, and then you'll even get lower interest rates and save a lot of money now and in the future. Overall, good credit just makes things easier. According to NerdWallet, the lifetime cost of higher interest rates from bad or mediocre credit can exceed 6 figures. For example, a study by Informa Research showed that someone with credit scores in the 620 range, which are below average, would pay $65,000 more on a $200,000 mortgage than someone with scores over 760, for instance, which is considered a great credit score. Another example, on a 5-year, $30,000 auto loan, the borrower with lower scores would pay $5,100 more. A 15-year home equity loan of $50,000 would cost a low credit score, $22,500 more than someone with a high score. You can clearly see how having a lower credit score can end up costing you big time. All right, so what is a credit score, and then what is good credit? A credit score is a 3-digit number ranging from 300 to 850 that defines how likely you are to repay borrowed money. The credit scores are calculated from information about all of your credit accounts, gathered by credit reporting agencies, i.e. credit bureaus, Equifax, Experian, and TransUnion. These 3 bureaus compile all the information related to your credit, and each produces its own 3-digit score. When you apply for a loan or a new apartment and then they run your credit, they might see all 3 scores or maybe just use one, but if they see all 3, they'll average them from there. In general, there are credit score tiers that you may get bucketed into when your credit is run. A score of 720 or higher is generally considered excellent credit. A score between 690 and 719 is considered good credit, and then scores between 630 and 689 are fair credit, and then all the way at the bottom, scores of 629 or below are considered poor credit. You should also note that creditors may look at your income and other subjective factors like your employment history as well. Credit scores are not the only thing that creditors might look at, but it's the biggest factor. All right, so how is my credit score determined? There are 5 main factors that make up your credit score. That's payment history, amounts owed, credit history, new credit inquiries, and then types of credit. Payment history makes up 35% of your score because creditors are mainly concerned with one main question, and that is, will this borrower pay us back? If they can run your credit and see a track record of all on-time payments, they're going to feel more confident about extending credit to you. If they see consistent late payments, or even worse, an account that went to collections, for instance, this can be a big red flag. My suggestion is to simply make every single payment on time and in full so you never have to worry about this factor. And that's 35% of your score right there. Accounts owed makes up another big chunk of your credit score at 30%. Creditors want to know if you're actually going to be able to pay them back or if you have too many balances and you might be at a breaking point. They factor in the amount that you owe on all of your debts in relation to the amount of available credit that has been extended to you. If you're using a high percentage of the available credit, the creditor then sees this as a red flag. Now, a good rule of thumb here is to keep your total amount owed to a minimum and definitely below 30% of your total credit limit. If your credit limit is, let's say, $10,000, and you end up spending more than $3,000 in a month, you would go above that 30%. And then that actually temporarily hurts your credit score. Whether it's one credit card or all of them, they look at it in whole. Now, the other three factors, length of credit history, new credit inquiries, and then types of credit, make up the other 35% of your credit score. Listen, I don't love these because they feel a bit vague and they aren't as clear cut as the other main factors. For example, if you're young, you obviously have a shorter credit history just simply based on your age. You can't do anything about that, and that's gonna ding you. If you're trying to build credit, you have to apply for new credit, so that can obviously work against you there as well. You also don't have too many options in terms of credit mix or variety. My suggestion is to focus on starting your credit history as early as possible. If you don't have any right now, start today. Don't apply for too many credit cards though, or too many types of different loans in a short amount of time. And then try to establish a good mix as you build up your credit. But you don't want to focus on building that mix first. Just start as soon as you can. And with that said, how can I build credit? We'll break this section out into really two main categories, either building credit from scratch or improving your existing credit score. If you're looking to build credit from scratch, we've all been there, right? At some point, all of us started from scratch. Start by opening a checking account with a bank or some institution that also provides credit through other products. Checking accounts don't necessarily have a direct impact on your credit score, but can factor into that institution's decision on extending credit to you later on. If they see positive behavior with your bank account, and you never go delinquent or negative balance, they may see you as a more reliable borrower than someone who has never even done business with them whatsoever. You can also open a secured credit card, which secures your credit limit with a deposit at that bank. The bank then uses your deposit as the collateral if you were to default on that credit card payment. If you want a credit limit of, let's say, $500 on that credit card, you would need to make a deposit of $500 at the bank. It's that simple. And then after time, eventually that bank should allow you to then convert the secured credit card into an unsecured credit card. And then when that happens, you'll have full access to the cash that they held as collateral. This allows you to start using a credit card early on and then build up your payment history, which again is 35% of your credit score. Just make sure that that bank or institution actually does report that secured credit card to your credit agency, because not all do. Also note that we're not talking about a prepaid card here. Prepaid cards are very different than a secured credit card. Prepaid cards also don't have any really impact on your credit. You can also look into getting a co-signer to co-sign a loan for you. This will allow you to get the benefit of the co-signer's credit history, assuming it's good, and therefore increase the approval odds in terms of your potential loan. As the co-signer is legally liable for any credit extended in these cases, you would typically only want to ask a close family member or friend to do this for you. A family member did this for me when I was in college and I needed a used car. I had to apply for an auto loan. That co-signer allowed me to even get approved for the loan, get a better rate, and then it helped improve my credit history going forward. The next time I wanted to, buy a car, they saw that I had done it previously. If you're looking to improve your already existing credit score, focus on growing your credit score with really good habits. You gotta start there. This starts with paying off all bills on time and in full. Don't let any balances carry over to the next statement period, which is typically monthly, and then do not pay a penny in interest. Don't pay interest. An easy step to take here is to set up automatic payments for each of your credit cards and loans that pay off the statement balance in full, so you don't ever have to log in and make that payment every single month. Use automation to your advantage and reduce the number of frictional manual steps needed to take positive actions. Let's say you have established credit and you spend too much on your credit cards and then you find it harder to pay these off in full. Stop using your credit cards for a few months and let yourself catch up. Take a breather. It's a really slippery slope into credit card debt, so don't let yourself get close to that edge. But that does not mean you should close your credit card accounts. I think this is a confusing topic here. In fact, closing accounts can be detrimental to your credit score actually, as it reduces your overall credit limit that we talked about previously, therefore increasing the percentage of debt owed of your available credit limit. Instead, keep these accounts open and just stop using them for a bit, but keep paying them. You should also know your credit limit on each credit card and spend no more than 30% of the limit at any time. If your balance goes above that 30% mark, remember, of your available credit, you'll see your credit score drop pretty significantly. This is a red flag to the credit bureaus, so avoid that threshold. Overall, your goal here in building your credit, whether from scratch or already existing, is to get that credit score above 720 or maybe even 750 and above. So you can pretty much guarantee yourself the most favorable odds and terms no matter what type of credit you apply for, whether it's a credit card, loan, mortgage, auto loan, anything. If you don't already, download one of the free credit monitoring apps that allow you to track your credit score. I check mine almost every day or maybe even weekly. And you might be surprised at how better understanding your credit score and just being more aware of it can actually lead to better financial habits in the end. Thanks for watching. I'm Tony from Wealthfront. Go out and take care of your credit.